Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 18th of February. I'm Daniel Lam, your host for the podcast. Well, to me in sports, there's nothing more exciting than seeing upset results. But unfortunately, I was on the wrong end of the stick in my national game selection over the weekend. Well, in financial markets, so far this year, Europe and China equities have outperformed the US equities. That's against consensus, and is a reversal of the trend over the previous 2 years. Well, there has been some recovery in the economic cycle from last year's lows, especially in manufacturing, which helps these two relatively inexpensive equity markets. Germany's upcoming elections on the 23rd of February, which is likely to lead to a center-right-led coalition government, is another potentially positive driver for European equities because such a coalition could introduce much-needed structural reforms and ease Germany's restrictions on fiscal spending. Trump's phone call with Putin have also raised expectations to an end of the Russia-Ukraine conflict, which has weighed upon Europe's economy. A US-led Russian-Ukraine truce should result in Europe boosting defense spending and lifting its manufacturing sector. Meanwhile, China markets have gained from a return of investor flows, particularly in the technology sector, after the emergence of China's low-cost AI model highlighted its growing competitiveness. The positive macro drivers shown above have helped marginally lift valuation multiples for Europe and China this year. However, this needs to translate into higher earnings estimate for the equity outperformance to sustain. Now, US earnings growth estimates remain superior but have fallen this year, with downgrades across sectors. Sustained declines here could improve the relative appeal of Europe and Chinese equities. Moreover, we believe the dollar needs to weaken for Europe and China to continue to outperform. Now, for all that to happen, Europe and China will need to take decisive action to stimulate domestic demand and negotiate trade deals with the US to ease the uncertainties from tariff. A Russian-Ukraine truce would help lower Europe's geopolitical risk premium. And for the US dollar to weaken, the Fed will need to start cutting rates again. But last week's hot US inflation data is likely to keep the Fed on hold for now. Without these conditions being met, we are staying overweight US equities. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.